Welcome back to episode 24 of the Real Estate Syndicator Live. Thanks for being here. And today we're going to be talking about the 4 pillars of every successful real estate investor must follow. This is not an original thought of mine. This actually comes from Robert Helms, co-host of the Real Estate Guys, who will obviously be here with us tomorrow. Will be here with us next week. This is something he taught me for the very first time when I first met him. This was about 18 years ago. And I think it's really important. And we'll go through each one of them. There's 4 of them. And they are your personal investment philosophy, your market, your team, and your property. So we're going to go through all 4 of those, but interesting comment at the end once we go through all 4, because I think a lot of people get that reversed, but important thing. So let's talk about the personal investment philosophy real quick. I'm going to do something that I don't usually do, and I apologize for those of you who are just going to hear the audio in this, but I'm going to share a screen because Robert had put together this really cool investment philosophy. I don't know what you call this thing, whatever it is, but it's really cool. So can you guys see that? I think you guys give me a thumbs up there if you guys can see the screen. So there's basically 7, when you're thinking of your personal investment philosophy, there's really 7 things. Thanks, Ashley. There are 7 things that go into your personal investment philosophy. First is just what's your primary objective? Like when you're either starting out as a real estate investor or you're even seasoned, it's always a good idea to kind of check in with yourself. But number 1 is, what's your primary objective? Are you investing in real estate for the income or for the growth? And these are the 2 extremes. So most people aren't going to be 100% or 1,000% income and they don't care about equity, or they're 1,000% equity and they don't care about income. You're going to be somewhere in between. But that's something you've got to sit down and think about, is what is your primary objective when you're investing in real estate? Second thing, obviously, is your risk tolerance, right? Are you conservative? Are you trying to preserve your capital, or are you aggressive and you want to swing for the fences and you're looking for, 60, 70% ROI annualized? So that's number 2 that you want to think about. Number 3 is the type of asset, the type of property. Are you a single family home person? Are you self-storage? Are you mobile home parks? Or are you larger buildings and multifamily, 100 units, 200 units? Commercial, what have you. So that's another thing you want to consider in your personal investment philosophy. Duration of investment's another one. Are you a short-term, sort of a fix and flip? Are you a sort of a burr strategy, or are you a buy and hold? Robert Helms always liked to say that he likes to think of himself as a collector of real estate, meaning his idea is that he never wants to sell. He wants to keep it forever. And at least that's his intent when he's going into a particular property. So that's, different philosophies, obviously, if you're flipping properties versus buy and hold. Your property profile, right? Are you looking for lower end, class D minus? I don't think SEP's on the call today, but SEP's always buying D minus properties. Or are you somebody that's want to buy, brand new development, class A, pristine properties? Management preference is another personal investment philosophy. Are you someone that wants to personally manage your properties, and therefore they need to be pretty close? Or are you going to hire a third-party professional management company? And the last one is just investment proximity. Are you going to be investing really close to your home? Or are you going to go, outside of your state, or in some cases outside of your country? We always talk about, Robert always talks about a particular investor that he knew that had a 20-minute rule, which means he never bought a piece of property that was more than 20 minutes that he couldn't drive to within 20 minutes. So, obviously he could stay on top of things, and he could manage those properties themselves, but obviously there's some limitations there. And he was just sort of missing out on a lot of opportunities that were available out of state. And in the case of Robert and even myself, worldwide investing. Robert also likes to say that, invest where you want to live, where you want to live, and invest where the numbers make sense. That's one of his sort of, one of my favorite quotes that he has. So anyway, so that's the sort of the first thing, which is you've got to figure out what your personal investment philosophy. I think that just comes back to also just, a lot of us are goal setters. I'm a big goal setting, but you've got to know the end in mind. You've got to figure out exactly what your goals are. And in the real estate context, that's where this personal investment philosophy comes in. The second thing is market, right? What market are you going to choose? And again, this can be in the United States or worldwide. And what does that look like? And that's specifically what I want Robert to come talk about next week. But generally speaking, markets are generally driven by population growth or population migration, right? The great example here is just recently over COVID, there was a lot of people moving from some states or some locations to others. and you've seen a reflection of that in the prices of those markets. And so you always want to figure out where exactly are people moving to. And a big factor that is obviously jobs. So jobs is one of the main driving forces behind population movements. And so where are the jobs and where are the people going? And so those are kind of things you want to do. But Robert just does an amazing job. He always talks, when he talks about the market due diligence, of not looking at one or two things. He's looking for a story in a particular market, and he's looking for 4 or 5 different factors. He always tells a great story. I think up in Modesto, everybody's talking about Modesto about 10, 15 years ago, because there was a new university that was being opened up there, and everybody thought that was a great market. And Robert's like, well, that's just one story. Like, what other stories do we have? Do we have job growth? Do we have something that's got a unique quality in that marketplace? And Robert's really well known for being able to find markets before everybody else does. And so I've learned a lot from him on the market side. But that's what I want him to come talk about next week. The third thing is your team, right? And when I say team, I'm talking about sort of your boots on the ground team. So we're talking about your real estate agent, putting that together, finding a good real estate agent, finding obviously a really good property manager, though that's obviously key, a local attorney, but putting your team together. Once you've figured out what your personal investment philosophy is, once you've identified a market that you want to be in, the next step is going to be the team and putting that together. Because there's only so much you can do, on Google. You got to go kick the tires at some point and assembling a world-class team. And in fact, a lot of my syndicator clients won't go into another market unless they've got somebody boots on the ground, people that they know, relationship that they have, because that's such a critical thing. And then the last thing, which is interesting, is the property, right? The property obviously is the property. Everybody knows what that is and all the details. We're not going to do a property due diligence tomorrow. I actually want to get somebody later on to come talk about property due diligence, but obviously the property is next. What type of property and what's the cap rate and all that stuff. But the interesting thing is most people focus on the property first. They're looking for a particular property. And when really the property is the least important of those 4. The property is the most interchangeable, right? Once you have your personal investment philosophy, that's number 1, market number 2, and you get your team 3, you can, properties come and go. But most people focus on the properties first, and they're just looking for the numbers, and they're looking for, the ROI and all that stuff. But having the right team and obviously picking the right market first that's congruent with your personal investment philosophy, that's really the key on these things. So those are the 4 pillars. I think the last thing I mentioned is looking at my notes here, just in terms of the team. I don't know if I mentioned that, but obviously you want a good local attorney. Not me, but a good real estate attorney or just somebody that can help you down locally, because a lot of things are local to a particular market. So in the case of real estate, for example, you want to have somebody in the local market that knows the real estate laws, not only in the state, but that particular county, and maybe even specifically in that particular city, local ordinances or whatever. So you want to make sure you've got somebody on your team down there that maybe they're not your main person, but you want somebody down there in the team. So those are kind of the 4 pillars. Next week, when Robert talks about the market due diligence, I'll probably ask him to talk a little bit about these 4 pillars. When I first thought about doing this live, he was actually going to be my first guest, because that was just, I've known him so long and he's been such a big influence in my life. I wanted him to be the first guest, and this is the topic I wanted him to talk about. Ended up having to just kind of start it off, and here we are, and he's going to be on episode 25. But I really want him to talk about due diligence, because nobody talks about market due diligence. Nobody teaches a class. And we're in discussions. I'm really trying to push him to do one last time to do that course, and maybe he can record it or something. And because I think that's a super valuable 2-day event that he used to put together. So hopefully he'll bring that back, because I think it's super valuable. I actually didn't buy my first property until I went through that due diligence course. But anyway, those are kind of my thoughts. A little bit babbling today, but those are kind of what I wanted to start with. But as always, more importantly, I want to make sure we're answering your questions. We've had a lot of guests, which is good. We've had a lot of guests over the last 3 or 4 weeks, and I think we've had some great content, but haven't had a chance to really do sort of an open AMA or Q&A. And so this will be a good opportunity for us to kind of catch up on any outstanding questions that you guys have on the legal side. And one came up on the community. And if you guys aren't part of the community, by the way, I highly encourage you to join the real estate syndicator community. A lot of great back and forth there. And there's a great question today about accredited investors of a fund. So maybe I'll start with that, but I want to give you guys a chance to ask your questions first. So if you've got any questions, pop them in the chat for sure, or just raise your hand and we'll get to those. And if not, while I wait for that, it was a great question. Mustafa, why don't we go with you, since I just saw you quickly raise your hand there. Go ahead, my friend.
Hey, Mauricio, just want to say thanks again for these weeklies. These have been invaluable and really awesome. And just a quick question. It may not be in the purview here, but curious, as a co-sponsor, do you recommend a certain type of insurance that business should have, whether you're a person or a corporation that is signed as a co-sponsor on a deal, if something were to go completely off the rails, and how do you protect yourself?
Yeah, that's a great question, and probably should look into having a live on that topic. It's really challenging. I'll tell you, I have actually found someone, but the idea is, and when you say co-sponsor, by the way, I'm just going to talk about sponsors in general, whether you're a co-sponsor or not. I think the sponsor team as a whole, or the management company, or the GP, however you want to put it. The question is there some type of insurance out there, and do I kind of recommend it or not? I don't know if I'll make a recommendation. I actually do think if you can, you should have an insurance policy that's going to cover you specifically if something goes south and you get sued by your investors. That's always the insurance that I've been looking for. I mean, yes, you want to have your just your general liability insurance on the properties, and you've got all types of other insurance. But what happens if, for whatever reason, property goes south and let's say you raised $3 million of equity from investors, and the investors decide to sue you for mismanagement or negligence or whatever it is that they're suing you for? Is there an insurance policy out there that will cover you for that $3 million that you've raised? And the answer is yes. I'm going off the top of my head here, but interestingly enough, when I found the broker, because again, I've talked to a bazillion brokers, and it's hard for people to get their minds around the syndication model, and they don't grasp it. But I finally found someone, and they were telling me it was actually a D&O policy, a directors and officers policy, with a manager E&O rider, I think is how they actually put it. But the idea there would be that if the investor sued you, you would be covered, assuming there's no fraud or intentional stuff, that you would be covered for that. The challenge has always been the cost, right? So on the one hand, you can spread that premium cost over all of your properties. So if you have 10 deals and your policy is X, you could split that policy among all of those properties, but not in the past, right? So only moving forward, which is challenging because without don't hold me to this, but when I was talking to the broker, ballpark to get, for that sort of $1 million coverage, the first $1 million was about $10,000 a year in premium. And then as you get more and more, it goes down. So the rough numbers were at about $10,000 for the first $1 million. I want to say it was, 60% of that for the second $1 million, 40% of that for the third $1 million. So, the challenge is a lot of syndicators obviously have a lot of capital raised, and they may have a 40, 50, 60, $100 million exposure. And that's always going to be almost impossible to cover. But then again, you've got to think that maybe, the odds of all of your deals going south at the same time are limited. But it's out there, and you can certainly split that thing, but it would make sense. It would always make sense. But if you're just starting out, actually, it would be great, because then you can, let's say you're ending up spending, I'm making this up, but even if your premium is $50,000 a year, right, for a $4 or $5 million coverage or something, then, what is that? $4,000 a month or something, which is a lot. But if you've got, 4 properties, and you can do that, $1,000 a property. And if you've got 8 properties, that's $500. So yes, the answer is I would highly recommend it. It is difficult to find. And, but I'm happy if you guys want to reach out, or maybe just, track me down on the community, the Facebook community, which if you're not a part of, it's mauriciorauld.com/FB group for Facebook group. I'll put it in the chat here, but yeah, great question. And it's a little bit of a boring topic, but maybe it's worth having somebody, or maybe that particular broker in mind, and just bring them on for a little educational stuff. Let me just put this in here, and then I see Kenneth has got some audio issues, but I'll read his question here. But let me just put this in here. It's mauriciorauld.com/FB group. FB group. All right. Kenneth says, I don't have audio capabilities. Can you address the following? Your thoughts on seller financing using an AITD, all-inclusive trust deed, taking title subject to the existing first. My thoughts on that is that, contrary to popular belief, I am not a real estate attorney, and that is a real estate attorney question. But I have been probably after Yona, so first week of September, We have, one of our newest junior partners, Bo. He's also a real estate attorney. And so I'm thinking of having him come on and talk a little bit about real estate. And that would be a good question to address. Ken, if you don't mind, maybe putting that in the community, posting that on the community, and then I'll have Bo take a look at it and we can answer it there. But I do want to have a real estate attorney on board. And so I'll probably just bring Bo on and he can, we can ask him a few questions, and then questions like this would be great. So great question, Ken, but I don't want to pretend that, that I know an answer. But yeah, look, I'm well known or best known for the real estate guys. So everybody thinks I'm a real estate attorney, and I'm the last person you want, putting together a purchase and sale agreement or pulling title or anything like that. Douglas, my friend, how you doing?
No, good. I just wanted to add some color to that. I am not anyone's attorney, and I don't play one on TV anymore. But in practicing law and looking at that issue a long time ago, I would say great to do it, but just understand there's a good chance that will violate the lender's restrictions in there. They could accelerate. Now, what I understand is they don't, but you are taking a bit of a risk by doing that. So that's the only thing I wanted to add to that discussion.
Yeah, that's a good point too. I mean, it's similar to asset protection, right? When people transfer, they buy a property, they set up an LLC, they transfer that asset to the LLC for asset protection purposes. Not theoretically. Well, actually, it is arguable, but obviously there's clauses there's a due on sale clause in the lending docs, and there's an argument that gets triggered. There's also an argument that doesn't get triggered. But practically speaking, it's very rare. Although I've always said that it's rare because for two reasons why it's rare. Number one, why would the lender turn a performing note into a non-performing note, right? Number one. And number two, I've already lost my train of thought, but turning the non-performing note into a non-performing note doesn't make sense when interest rates were super low. But I do see scenarios where if interest rates get to like 8, 9, 10%, I'm not saying they are, but if they get relatively high, now there's an incentive for the lender to say, well, this guy's got a 3% note, a loan for 3%. It may make sense to call the note, and then they can just reissue that, at a higher interest rate. But with interest rates so low, I remember my second one. It's just there's no incentive for the lender to turn a performing note to a non-performing note. And then, man, I can't believe I lost my train of thought twice in a row. It's hard for me to walk and chew gum at the same time. No, the other one was that if lenders starting to do that, right? Think about it. If lenders started to call notes in the due on sale clause, then real estate investors wouldn't use them. I mean, this is a common practice. Is asset protection. Asset protection is paramount. You don't want to be a real estate investor out there buying all these properties and just being exposed. And so real estate investors are going to transfer those into the LLCs, and they're going to ask for forgiveness as opposed to permission. And if ABC Bank starts getting a reputation for pulling this off, then they're not going to go to ABC Bank anymore, and they're going to start using other banks that are friendlier. So that's another reason why I don't see it. But having said that, that's only because of the low interest rate environment for the last, bazillion years. And I could see as interest rates rise, if they continue to rise, you get to a point where it may make economic sense for lenders to call the note so they can then, foreclose or whatever, and then reissue a note at a higher interest rate. Let's see here. Oh, cool. Oh, I definitely want to mention this. Let me see it before. I'm seeing your note, Ashley. Tristan got it. So I'm going to mention this because Ashley Wilson, who's just provided so much value for not only the community here, but just in general. If you don't follow Ashley Wilson especially on LinkedIn, I think that's where I see most of her stuff. It's really great. I know they have an apartment addicts coaching program, and they were just mentioning they have several hours worth of content on market selection in that coaching program. So Ashley, just feel free to pop that in the chat. Everybody sees the chat, so feel free to put that in the chat. And if anybody's interested, they can take a look at that. Tristan, even with interest rates rising, they would lose their income as they borrow would go to another lender. Yeah, I think when interest rates rise, that creates all sorts of issues. But the other question that I saw in the community that I answered, but I thought it was a great question. It's something that's really interesting is when you're doing funded funds. So let's talk about funded funds for a little bit in terms of accredited investor funds or non-accredited investor funds that are investing in the sub-syndication, the funded funds that are 506C deals. So the question that I rose today on the community was, if you put together a fund with the intent of investing in other funds that are 506Cs, can you have non-accredited investors in your main fund? And the reminder I was letting everyone know that there's, even though we always talk about net worth requirements, even though we talk about having the fund being accredited only if all of the members are accredited. So theoretically, if you have one non-accredited investors, then that would be a non-accredited fund. One of the other ways that an entity can become accredited is if they have $5 million in assets that was not created for the sole purpose of investing in that fund. And so you would have to argue that you created sort of a blind fund and you raised $10 million and it wasn't specific for the particular fund that is at issue. But generally speaking, when that rule pops up, the $5 million of assets, it generally involves, businesses. Like I always give the example of the doctor's office. Like if you have a medical practice with 20 doctors, and that LLC or LP most likely, they own the real estate that they practice. They've got all this equipment. They've got all these other assets, accounts receivables, what have you. If that group of doctors, that LLC has more than $5 million in assets, then even though one of those doctors might be non-accredited, they would still be eligible to invest in one of these 506C deals because that entity is accredited. Because like I mentioned, you can be accredited if you have more than $5 million in assets that were not raised for the specific purpose of investing in that. So I thought that was an interesting comment in the community, and I wanted to address it here. But thanks, Ashley, for putting that in there. And no, please ignore. All right. Any other questions that are on anybody's mind? Or after 24 episodes, have I really answered all the questions out there? We're going to be doing a lot more guests. I mean, that was, I'll be honest with you guys. One of the reasons I wanted to do the guests more than anything is at some point I kind of run out of things to talk about or get bored of what I talk about. So having guests in town and making sure that they're talking about things that are important to syndicators has always been a big deal. Most of the podcasts you'll see out there are geared towards limited partners. There aren't too many podcasts that are really geared to syndicators, and I want to make sure that we just figure out every single little thing. So if there's a topic you guys want to discuss or something, feel free to drop it in the Facebook community too, because I'm always looking for ideas. All right. Anybody else have any questions, or shall we just all reconvene next week when we've got the one and only Robert Helms in the house? Let's do that then. All right, let's do that. Let's reconvene next week, and we'll have Robert talk about the due diligence, and then we'll open it up to questions for Robert, whether it's on the due diligence topic on the markets or if it's on even the 4 pillars that we talked about. Tristan, I see a question, your hand up there if you want to hop in there before we hop off.
Sure, thanks.
Yeah.
I was just going to say about next week, and probably not the right time, but how would I connect with you just to sort of sort out next week? You mentioned trying to get somebody to the meetup, so I was just going to see if I could arrange that with you and the other party in Phoenix.
Oh, in Phoenix, let's talk about, yeah, I got it. I was trying to figure out next week about the Robert Helms. Yeah, let's talk about that offline. Let's talk about that offline. We'll figure that out. Yeah, I'll be in Phoenix. Maybe that's another announcement. I'll be in Phoenix next week talking at Mike Angelo's meetup there next Wednesday. Ashley, you got a question?
Actually, I was just going to add something to Robert Helms's 4 pillars. I actually found it interesting because it's a little different than a few years ago. Like, I want to say, I think it was like 7 or 8 years ago, I wrote something for Bigger Pockets on something very similar to this, but I actually called it the 3 like points of a triangle for real estate investing. Mm-hmm. And I broke it down a little bit differently. I didn't have personal investment philosophy, so I like that component he added, but I broke it down into you have your capital, you have the property, like the metrics of the deal, inclusive of markets, and then you have your infrastructure. So that's inclusive of both people and systems. Yeah. And my whole philosophy behind that is as you continue to scale and you continue to go through different market cycles, your problem shifts around that triangle. And in terms of growing, whether it be, do you change, and it's all kind of wrapped into your investment philosophy, but do you change what properties you seek? Do you change in terms of your teams and your systems you're building? Do you bring in vertical integration? Do you, especially with multifamily, there's so many systems and tools out there. Which systems do you start to integrate into your overall operations or acquisition or capital raising? Like, for example, investor portals. But ultimately, as you're growing, it continues to kind of go around this triangle. And it really makes you shift your focus, because ultimately it's very difficult to have all 3 points of the triangle operating without like some stress on a certain part of it. Because as you have, a lot of capital, you might not have as much deal flow, or you might have a lot of deal flow, but you're stressed on capital and manpower. I actually wrote this before getting into multifamily. I wrote it when I was in single family, but I extrapolated across all businesses. It's really just kind of a change in mind shift or mindset on the verbiage you use, but ultimately it's really kind of the same thing when you look at any business on scaling.
Yeah, no, I love it. And it makes sense, especially on I guess if you incorporate the personal investment philosophy, when things change, right? If you like in your things shift all the time. And even now, let's say you're going through, let's say we end up in a recession or things are changing, then, maybe your risk tolerance changes, or maybe you're like, hey, my duration of time, maybe I'm not going to do any flips anymore because, the market might be softening. And so I want to go to longer ones. So that totally makes sense to me. Where do you have, and then by the way, capital, maybe I'm thinking of capital specifically for syndication. So that would be more on the syndication side. Although obviously you need capital down payment and debt. Where's the market? Because I love the fact that you've got the information, the infrastructure, which is not only team, which is Robert's, third item there, but teams and systems. So I love that. Where do you put picking the market in your triangle?
Within
Property?
property.
Got it.
Property,
Yeah.
because it's really product. So when you think of it in terms of a business, it's not property, it's product. So whatever that product is inclusive of all the components of it. So, if it's in terms of it, if you have to shift markets, certain markets are more conducive to certain types of properties than others. So it all kind of gets wrapped into that bucket.
Yeah, no, I love it. It'd be fun to have you join us next week and bring that up to Robert, because that makes a ton of sense to me. What was interesting to me that Robert always stressed, and that was kind of really the punchline that I wanted to do on this thing, is that most people, especially when they're starting out, they just rush in and all they look at is the property, and they're looking at what's the ROI and what's the occupancy and what's this and what's the other, and they don't really think about, well, do I have a team in there? Do I even know what do I even know what rents are? Do I really have anything, any information on the particular market? Have I done any research in the market? I'm sorry, on the team. And then the market, you could have the greatest property in the world, but if it's in a market that's going to decline, 60% over the next couple of years, it doesn't matter how good the property is. That's not going to be a long-term, especially if your investment philosophy is on the shorter end, right? If you're going to go in there and get out in a year or two, and the market turns on you, and then on the flip side, the market can always bail you out, as you pointed out. These days, a lot of the market has been bailing out a lot of investors. And investors may have made poor property choices or poor capital stack choices, but you know what? The market will bail you out. So I think that was Robert's point, is that it's really, you start with that investment philosophy kind of goals, and then you start making your way. It's almost like an upside down triangle, right? You start with the personal investment philosophy at this point, and then you kind of narrow it down all the way to the property.
I think
I
also, to just add one more point, I think it's not only the viewpoint of active investors, but also passive investors. But at the end of the day, most people invest because of the person. They have a trust associated with the person. So there's something, that we advocate for all of our students, that you should start raising capital before you have a deal. Mm-hmm. And, meeting with folks like you and Bethany to help come up with a structure and also make sure that it's compliant in the manner in which it's done, but creating almost like a pseudo a deal, like a one pager, to let people know this is what it's going to look like when it comes across the table, but to get people comfortable with the investment structure, the vehicle, everything around what someone's business plan is, because they're ultimately investing with you as a person. But most people are so stuck on the fact it's the deal and it's the return.
Right.
I know so many investors who will take a haircut on the investment return to invest with certain people than to take a gamble on someone they don't know with forecasted higher returns.
100%. And the interesting thing is, like, I think this one, when it was originally brought up 15 years ago or 18 years ago, however long I've known Robert, this wasn't really a syndication thing. And I wonder if we should come up with our own our little pillars on the syndication side. And you just gave me a great idea, Ashley, because I've got and we're going to talk about it in 2 weeks, which is the 8 critical steps to practicing safe syndication. And a lot of the things you just mentioned in there are definitely, we just talked about that. I just did a report on it, on how critical it is on the sponsor. That's probably the most important. If you're a passive investor, the most important thing that you should be considering is the sponsor, the experience, the track record, all of that stuff. This was really meant more as sort of individual, if I'm going to go out and buy a property on my own. But I think maybe you and I can put our heads together and come up with an updated pillars for real estate syndicators, as opposed to just somebody who's going to go out there and go buy a fourplex or something on their own.
Absolutely. Happy to help.
Yeah, great. And apartmentsaddicts.com. I would highly recommend that. We need to do something together in that, because you've got a great coaching program there, Ashley. So if anybody's interested in that, I would highly recommend checking out apartmentaddicts.com. Thank Ashley, as always. We had a good time last week at Bubbles with Bethany. If you guys haven't done that yet, I had to cut it off after almost 3 hours of some champagne there. Mustafa, you've got a follow-up question?
Yeah, thanks for giving me a second chance. That kind of brought something to mind. If you're a co-sponsor or a sponsor, you're growing your team, whether it's on the marketing side or you have an investor relations person, and whether they're like an employee or a contractor, what are some of the things that you need to ensure? First of all, are there specific licenses that any of these teammates are going to require to be compliant? Just more on the compliance side of things. I was curious if there's anything there, any advice that you can give any of the people here building out their teams and growing as they're onboarding either full-time, part-time employees, or even contractors. If there are certain licensing requirements that they would need to perform any of those jobs.
It's interesting. I'm not sure I'm going to answer your answer directly. I might rely on Ashley here because she's got so much experience in it. But one thing I will say is, as you're building your team out, because you asked the question about insurance at the beginning, keep in mind that all of those team members, for example, your property management company, your third-party property management company, you should have insurance to make sure that they are covered as well. So whatever policy you have, you want to make sure those individuals and companies are third-party included, because if the property manager does something inappropriate, whatever it is, right? If they violate some kind of law, whether it's a harassment thing or what have you, you're going to be on the hook for that as the owner, even though it's a third party. And so one of the best advices we've ever had from insurance counsel, which is another topic we can talk about, is to just make sure that you add those third-party vendors that you use or who are acting on your behalf, make sure they're added to your insurance policies, because yes, they should have their own insurance policy as well, but maybe they're underinsured, maybe they're, whatever, they've got exclusions. You've got maybe we do need to do an episode on insurance. I got my pet peeves on insurance, but anyway, that's kind of the thing I want to do. And then on licensings, and Ashley, if you want to comment on that, I'd love to get your thoughts on the licensing. Whether it's required or not, part of it would be, is it best practice? So obviously a property manager, you want to make sure they've got the proper licensings. If you're doing value add and you're getting a general contract, you want to make sure those folks are licensed. Obviously you're going to legal counsel to be licensed, but Ashley, any particular team members that you sort of insist that they better have a license, otherwise they're not going to be a part of your team?
Yeah, I definitely think this would be a good topic for a whole night's discussion. Just because from start to finish, you really need to make sure that you're safeguarded against exactly what you just talked about, that liability exposure. So starting off from due diligence, when you get a property under contract and you go to do due diligence, you have to have insurance taken out to cover every single person on your team that steps foot on that property. That's inclusive of all the general partners, your property management company, and the contractors. So typically your property management company, I mean, it varies by property management companies, but a lot of property management companies will open up coverage for all the team members, the general partners who are going to be on site doing the DD with the property management company, and place them under their policy. The contractors, they need to provide coverage as well, and you have to submit those in advance prior to stepping foot on the property to do all of your inspections. So that's first and foremost. With respect to the contractors, I always advise, which, take it with whatever you want to interpret that statement, but I always advise that when you're doing any work on the property with respect to contractors, anything that particular area requires licensing and permitting, anything that typically requires permitting ties into licensing as well, most of the time. So every single submarket is different. Municipality, you have to check what regulations are in effect. And also too, every single municipality also has different habitability rules. So with respect to purchasing a property, habitability can come in within a certain period of time and require renovations to occur, and they will also need to be licensed, insured, and permitted. So when you're getting quotes for, your DD process, there are different price points depending on whether or not you are going to mandate that those repairs are done properly with a licensed and permitted electrician, let's say, for example, or an HVAC technician. Those need to be considered when you're doing DD, because the last thing you want is to get all of these quotes and then realize those quotes were under the assumption that you're not permitting the process. That opens you up to huge exposure from the city with fines. And also too, they can require you to rip out the entire renovation that you've done and redo all of it all over again on top of the fines. It really is dependent upon the local municipality. So that is, on the contracting side. Mauricio, you mentioned the property management side. I didn't know this when I first got into multifamily, but a property management company has to be backed by a licensed broker. And the property management company can only hold their operations through a broker. So that property management company either has to have a broker on staff or needs to be affiliated with a brokerage. So you want to make sure that they are compliant, because with respect to all of the legislation they need to follow, there is a lot of legalities when it comes to leasing and operating properties. You want people who are very knowledgeable, that are up on their training, and heavily involved in local apartment associations, because that's oftentimes how that dissemination of information gets passed through to, property management companies, et cetera. So that's another area.
Yeah.
And then,
and by the way, and just let me just interrupt real quick. And just they're going to have their own insurance, but I wouldn't necessarily rely on that, because who knows the quality of that insurance? Is the insurance going to be there if something happens? Is the insurance enough? Are there exclusions in that insurance policy that, whatever? And so even if which they should have insurance, you want to add them to your policy, because presumably you've done your due diligence on your insurance policy. You didn't just grab the cheapest thing out there and just for legal purposes, you've actually got a good solid insurance policy, and just make sure that you add the property manager and all of these other electrician, HVAC, and all these folks to those policies. Good. But finish up, Ashley. Thank you.
No, I completely agree with you. And along with the insurance for the property, you also want umbrella, general liability. If you're located in a flood zone, that's a whole topic for another night, because the flood zoning, the flood insurance just changed October of last year, FEMA's policy and rates. I personally believe that unless something changes, any property in flood zones are going to be uninsurable soon, and they're going to be very hard to transact. But that's something that you want to make sure you have covered. And then also too, and I think Mauricio, you probably can speak better to this, when you are raising capital, utilizing someone who has their broker-dealer license for soliciting funds and how that compensation structure works, which I'll leave that for you to cover, because you probably know that a lot better than I do. But that's something that I rarely have seen in practice. But I know that's an option for people to exercise.
Yeah, and let's talk about that, because I know I talk a lot about it, but I think it's super important. And yes, that's another area where you want to make sure that if somebody is a true capital raiser and is raising money for you, that person is licensed. And the challenge is, which is why they try to pass this, or they had a proposal anyway to allow capital raises to actually get compensated, is because on the one hand, you're supposed to use licensed broker dealers to help you raise the capital if you're going to pay somebody. But on the other hand, broker dealers don't like to get out of bed for less than 25, 50, $100 million, right? So here we are, in the scheme of things, we're sort of small capital raises. We're raising 5, 10, $15 million. We're not raising 50. And so it's often very difficult to attract a broker dealer. Having said that, I do have clients who do use broker dealers, and it's a relationship thing too. Like if you don't have a relationship with a broker dealer, you're brand new, there's no chance you're going to have having a broker dealer work with you. But if you've got some experience, I have seen some clients bring in licensed broker dealers, or at least an agent that is has a license, maybe it's an investment advisor that hangs their license under a broker dealer, and their compensation, the ones I've seen, because they have been smaller raises, they've been like the 3 to 5 million, range, which is typically one that I would say there's no chance you're going to have of finding a broker dealer. But I have seen some using it, and it's been a combination of sort of a lower percentage, 2, 3, 4%, in conjunction with a cut of the GP. So depending on how much they raise, they'll get 4% or 3% of that raise in addition to X amount of the GP. Again, if they're a licensed broker dealer. The problem we're having these days, as you know, Ashley, is that too many people are out there doing this without a license, just going out there and bringing people in and getting compensated as a piece of the GP without actually doing any work, or what we would call substantial work in the deal. And that's great. Their primary role is really just to come bring in the capital, which again, if they're not licensed, that would be an issue. Tristan's asking, what is a process to become a broker dealer? Is that similar to a real estate broker? No. So a real estate broker is completely different from a broker dealer. We actually looked into this, when I'm not sure if people know, I used to be general counsel for the real estate guys with Robert and Russ. And at some point we were looking into becoming a broker dealer, and it was so freaking complicated and expensive. At the time, this was 15 years ago, it was about 500 grand to start a broker dealer firm, that it was much cheaper to actually acquire one. So if you're thinking about being a broker dealer, you're much better off trying to find one that already exists, that already has all the compliance in place and all the everything in there that you're just acquiring. But the major pain of being a broker dealer, and why most people, it's not something I would honestly even consider it, is just the compliance, right? I mean, all of the scrutiny that you're going to have from the SEC and actually FINRA, just all those annual filings and the audited financials and the disclosure stuff. I mean, you're under a really heavy regulatory body. So if anything, I would try and do the level below that, which is to become a registered investment advisor, which is a little bit easier, and then go find a broker dealer to go hang your license under. Just like the real estate agent is easier than you go hang your license under a real estate broker, you can be a registered investment advisor that can then go hang their license under a broker dealer, so that the person's actually paying the broker dealer the commission, and then the broker dealer then splits that, whatever the arrangement is with the investment advisor. But it's extremely cumbersome, maybe it's the best word, and expensive to be a broker dealer. So unless you're going to do this for a living and you think you can go raise hundreds of millions of dollars, it probably doesn't make sense. Yeah. Tristan, acquiring it makes a ton of sense. Hey, Ashley, maybe we can talk offline. I think, and maybe we can. This sounds like a great topic. I think one topic we've come to realize that insurance is something that, again, kind of like the key principle that we did a couple of weeks ago. That insurance is a topic that isn't covered too much. It's not sexy, but it's important. And I do have a really good contact, good friend of mine, a good contact of mine who's a real estate, who's an insurance attorney. And we've used him in the past, and he would be a great guest to come on and talk about all the different insurance types and what covers you for this and what covers you for that. So that's one thing I think we talk about. But Ashley, maybe you and I can have you, because I know, for those of you who don't know, Ashley, you were like, I think episode 2 or 3 of the Real Estate Syndicator live that you did. But maybe we can bring you back, and maybe you can be our first repeat guest, and we can talk about sort of the teams and making sure that, when you're scaling and you're putting together your team, sort of the do's and don'ts, or the things to look out for when you're putting together your team, if you're up for that.
Yeah, absolutely. And I also wanted to mention, I kind of misspoke earlier when I said that the property management company has to have a broker license behind them. There is a caveat to that, which is that if they are part of the GP, or you have vertical integration, you don't need to have a broker's license behind the property management company. Mm-hmm. So if you bring them in-house, or you JV a deal with a property management company, which is not out of the norm, that provides an opportunity for you to kind of get around that. Yeah. So I just wanted to say that. With respect to insurance, I'm not as well versed on general insurance coverage I know enough to play in this space, but I really rely heavily on our insurance broker. But I do have to say that I am pretty well versed on flood insurance. Mm-hmm. And that's due to the fact that we almost lost a deal over the change in flood insurance. So just kind of give perspective, the current insurance coverage on a property was $955 a door. And just due to us purchasing the property, even though they had just put that property insurance in place, the only rate that changed was flood insurance. So the total went up to $1,700 a door. Everything else remained at the same rate. So for that reason, I became very well versed on flood insurance.
Is that in Houston? That's
a property in Houston, and it basically comes down to that thema changed their insurance calculation for good reason, for good cause. Obviously, the risk of natural disasters is higher, coupled with replacement cost value is significantly higher. But they also did a new algorithm that not only looks at the risk of flooding, but they look at the risk of nearby flooding. So that is kind of like the X factor that has made this rate kind of just out of control. It's ridiculous. So there's one loophole around it, which is something I was able to identify after hours and hours with pretty much every single insurance broker I could find that would talk on the subject. But that's something that I think, would be of interest to anyone who's looking at or considering a flood property. I'll try to find a link. I did a talk on this with Matt Fairclough's group, DeRosa group. I don't know if anyone knows that group.
Can you post, if you can't find it, can you post that on the community page?
Yep, I can.
That would be awesome.
I can share it right now.
Oh, that's perfect. You can share it right now, even better. That way people can see it. You've got it.
And this kind of summarizes.
And by the way, just as you're looking at that, by the way, I just realized that, if at any of these lives you want to get a copy of the chat, because I know a lot of times people are interchanging contact information or their links or whatever, you can always just reach out, because the Zoom recording always records it, and we can always just, we can send you a copy if that's something you're interested in. So there it is. Oh, it's a YouTube video. Cool. Awesome. All right. So I got my new topics here. So I appreciate that because I'm always looking for what's relevant for the syndicator community, not necessarily what's relevant to me. So Ashley, we are going to connect and figure out a good topic around this. And then definitely the insurance is something we want to talk about as well. But appreciate your time, Ashley, today. Really, really appreciate you adding all this value to the community. So thank you for that.
Happy to
And
help.
yeah, thanks. And I will see you guys next week then. Robert Helms talking about market due diligence. And as always, thanks for joining us every week. Really appreciate you guys. Bye, everyone.